Today I'll be showing you the perfectly legal tax strategies that the IRS would prefer that you don't know about. As a registered CPA and owner of a tax planning company, TaxHelm, I've compiled specific approaches that maximize savings while working entirely within the IRS guidelines. That's exactly what I'm going to talk about in this video today, to show you these powerful tax strategies that are completely legal but rarely discussed. So let's dive right into it. And the first concept or strategy I want to talk about is this idea of maximizing deductions. Now, I'll tell you what this strategy isn't. It isn't going out and buying a piece of equipment that you don't need for a tax deduction. It isn't going out and buying a new vehicle that you don't need for a tax deduction. When I talk about maximizing deductions, what we're talking about is taking after-tax spending and moving it to pre-tax spending. And as a business owner, you have this really good advantage that you have any expenses that happen within the business are all pre-tax spending. So as a business, you have your revenue or your sales, you have all these expenses that go into it, and then whatever's left over is your profit. And your profit is what you get taxed on. So any spending that you do within the business is what we call pre-tax spending. And so when I talk about maximizing deductions, that's what I'm talking about. How can we take spending that you're already doing, that you're going to do no matter what, and find a business purpose for it and move it from after-tax spending into pre-tax spending? So when we talk about these types of things, we're talking about home office deduction. You know, that's spending that you're going to do whether you own a business or not, but now you get a partial business deduction for it. We're talking about things like automobile use. We're talking about technology, cords, phones, cameras, lights, all those different things. We're talking about meals and travel. How can you associate business around these everyday things? We're even talking about things like hiring your kids and how you can get a business deduction for supporting your kids, which you're going to do anyways, but now you can find a business purpose for that support and get a business deduction for it. So that's what we're talking about, maximizing deductions. And this is so powerful because this is directly allowed within the IRS code. If an expense is ordinary and necessary for your business, ordinary, necessary, part of having your business operate, part of getting your business to grow, part of keeping or retaining team members. If a business expense is ordinary and necessary, it's a valid business deduction. So this is a super powerful thing to do. Now, I recommend downloading my Maximizing Deductions guide, which you can find at taxsavingspodcast.com/deductions. And we talk about all sorts of things, including inside my book, Small Business Tax Savings Handbook. But these are the type of concepts that we're talking about: home office, automobile, meals, travel, technology, finding business purposes for these things, expenses that you're going to do anyways, but now we're finding a business purpose for it, moving it from after-tax spending into pre-tax spending. So the next time that you hear maximizing deductions or this concept, or you hear your accountant say, let's go out and buy a vehicle to get a tax deduction, say, let's first work on maximizing deductions. So that's item number one. The second one is using a health savings account for triple tax advantages. So a health savings account are allowed if you have a high deductible health plan. And there's some regulations on what qualifies as a high deductible health plan, but there's a lot of health insurance plans that qualify as a high deductible health plan, which then open up or unlock the door for a health savings account. And the beautiful thing about a health savings account is that you get a tax deduction when you put money into it. If there is any growth within those funds, within that HSA, they grow tax-free. And if you use funds from an HSA, you can for qualified medical expenses, you get they come out withdrawal tax-free. So you get a tax deduction going in, tax-free growth, tax-free withdrawals. This is like any other tool that the IRS has ever given us. You might look and say, okay, a Roth has tax-free growth, tax-free withdrawals in retirement, right? But you don't get a deduction going in. A traditional IRA, you get a deduction going in, tax-free or tax-deferred growth, but you're taxed on the withdrawals. With an HSA, you get the benefit on all ends. Tax deduction going in, tax-free growth, tax deduction, or tax-free when you withdraw those funds. So this is a very, very powerful strategy. And a lot of people come to me and they say, Mike, I'm healthy. Why do I want to fund money in a health savings account? And I'll tell you what I do. And what I recommend that everybody does is think of a health savings account as a retirement account. Don't utilize those funds to pay for medical expenses until you're way down the road. Let those funds grow tax-free in this very cool vehicle that you have, and let them grow tax-free, and then withdraw them down the road when you maybe need medical expenses when you get to retirement. Instead of pulling taxable retirement dollars to pay for those medical costs, then you can use your health savings account that has grown tax-free, and now you have tax-free withdrawals. So that's what I recommend utilizing for. Now, one key caveat to that. Let's say that you're funding an HSA, maxing it out every single year. It's growing, it's growing, it's growing. You're paying for medical expenses on the side, not using your HSA, but now you run into a bind where you're kind of tight on cash. What can you do? You can take receipts from all of those medical expenses over the years, and you can submit it to your HSA provider and get a reimbursement tax-free for those receipts, even if it was 3 years ago, 4 years ago. So that's the power behind an HSA. We recommend that everybody with a high deductible health plan be maximizing out an HSA every single year. Now, the next item is structuring real estate investments to maximize depreciation deductions. And real estate can be a super powerful tool, not just a wealth building tool, but a super powerful tax strategy as well. And there's different avenues of this. If you qualify as a real estate professional, if you qualify as an active participant, if you're buying a short-term rental, there's a lot of power behind that. But the concept generally with real estate or rental properties is that you get such a big tax deduction, or you can get a tax deduction upfront via the form of depreciation, that oftentimes you're cash flowing on these properties and you're not paying any taxes on it because that depreciation is offsetting the income of that. So you have money coming in that you're not paying taxes on. This can be super powerful. We did an example where we took somebody that was making $100,000 a year that got into a real estate, and they were cash flowing about $20,000 a year in that real estate project that they had. They weren't paying taxes on that. So they went from making $100,000 a year to $120,000 a year, but they didn't pay any increase in taxes by bumping to 120 because depreciation was offsetting that. And on paper, on their tax return, they weren't making money there. So another opportunity too with this is a short-term rental that has that potential where you can take those losses that you have, instead of carrying them forward, you can take those losses from a rental property in the early years, and you can use it to offset some of your W-2 income, your business income, various different things like that. So if you haven't thought about real estate or haven't looked at real estate, just maybe put that in the back of your head. Think about it as not only a great wealth building tool. Most of the wealthy individuals I talk to are somewhat involved in real estate somewhere, somehow. But not only is it a great wealth building tool, but it can also be a great tax savings tool as well. Now, since I can only cover this strategy here in so much detail, I don't want you to walk away from this video and fall into the general content trap, where you become so wrapped up in general advice online that you never take action. And this is exactly why I want to offer you an entirely free demo call, where we'll look at your exact situation and help you come up with a game plan for your taxes. Click the link below to book your free demo call now. Back to the video. The next piece is utilizing a cost segregation study for accelerated depreciation. This kind of goes back to that idea of real estate. So real estate, typically, if you buy a personal residence or a long-term rental, not a commercial building, you're going to depreciate that cost of that over 27 and a half years. So let's say you buy a $100,000 building, just for easy math, and you're going to depreciate that $100,000 over 27 and a half. Now, land is not depreciable, so just keep that in mind. So then, and if it's a commercial property, then you're depreciating it over 39 years. So this idea of a cost segregation study is saying, hey, we don't want to depreciate this over 27 and a half years. We're going to pick and pull different pieces of that property out, and we're going to depreciate it faster. So let's think of that as an example. If you have a building that you buy, well, you have plumbing in there, you have appliances, you have flooring, you have windows. All of these things aren't necessarily going to last 27 and a half years. And so the IRS allows you, through the form of cost segregation, to take and separate out some of those costs that you can depreciate quicker because they're on a quicker depreciation schedule. So what this can do is it can front load, instead of depreciating your property over 27 and a half years, maybe you get a big year one tax deduction on some of the property that you can depreciate right away. Maybe in the first 5 years, you're getting more depreciation up front to help offset income from that property, offset making sure that you're cash flowing, but not paying taxes on it. Or even better, you're creating a massive loss from this rental property that can offset income in other places if you qualify. So a cost segregation study comboed with real estate can be a super powerful way to accelerate depreciation. Now, one factor on this, I highly, highly recommend that if you go down the cost seg route, you go with a trusted partner. These things are complex. There's a lot of things. You got to dot your I's, cross your T's to make sure you're doing it right. This is black and white in the tax code, but they don't tell you about it. But you got to make sure that you're doing it correctly. So we always recommend utilizing some sort of provider that can help you create that study for you, break those pieces out, has the documentation to help support that. Finally, a strategy that the IRS doesn't talk about too often is employing family members to help shift income into different tax brackets. And we talked about this briefly in the concept of maximizing deductions where you're hiring your kids, but it doesn't necessarily have to be just your kids. Maybe it's your nieces, your nephews. Maybe it's your older or aging parents that are doing some work for you. You want to support them, but they're doing some work on your business. Now you can get a business deduction. They're maybe in a lower income tax bracket and we're shifting that income. Where I really love this strategy is hiring your kids because it allows you, we know I'm a father, we know we're always supporting our kids in all sorts of ways. And I don't care what age they are, we're supporting our kids in some way. But if your kid is under the age of 18, there's a potential that you can hire your kids in your business for work. They have to be doing legitimate work. And we got to be making sure we dot our I's, cross our T's on that. But you could hire your kids in your business, get a business deduction, and your kids pay no income taxes on that income that they received. Think about this. You're getting a business deduction. You're shifting this to a zero income tax bracket. And all you have to do is make sure that you're dotting your I's, crossing your T's, they're doing work for you, you're doing things the right way. This can be a super powerful strategy, again, in an expense that you're going to have no matter what. You're going to send your kid to basketball camps. You're going to send your kid to amusement parks with their friends. But now we could potentially get a business deduction for it, and your kids pay no income taxes on it. Now, again, we need to make sure we're doing this correctly. We need to make sure that they're doing actual work for us. We're paying them a rate that's reasonable. We're dotting our I's, crossing our T's, flowing the money in the right ways, in the right places. But this can be a super powerful way to do this. Now, one final note on this whole topic, this strategy, these ideas, is the government in the tax code wants people to be business owners. So what do? They give incentives. And what we talked about today, maximizing deductions, real estate, cost segregation, hiring family members, doing those types of things, the health savings account. All of these are incentives that the government has given us through the form of the IRS code. But you'll notice you don't see these things plastered on billboards. The IRS isn't shouting out these different things. You also don't see the IRS knocking on your door and say, hey, I noticed you have kids, but you didn't hire them in your business. The IRS doesn't do this. So it's your job to understand what's available to you as a business owner, take that from the IRS code, correctly implement it, and take advantage of this incentive that the government is giving you, but they're not going to shout out from the rooftops to tell you about. So now that you understand these powerful but often overlooked tax strategies, what fascinates to me the most in my tax practice is how many completely legal opportunities the IRS doesn't actively publicize. Through years of tax planning, I've discovered that optimizing your tax position isn't about these aggressive schemes. It's about understanding and properly using the tax code to your advantage. The most tax efficient clients I work with aren't using complex loopholes or different things. They're just strategically implementing well-established tax rules that most people never hear about. And if you want me to analyze your tax situation and show you how to properly implement these IRS-approved strategies, click the first link in the description and book a complimentary demo call with our team. I'll see you in the next one.